Did you know your Instagram posts could boost your credit score? It's not science fiction. It's the future of credit scoring in 2025. In this video, we're pulling back the curtain on how AI and alternative data are revolutionizing the way lenders see your financial story. Get ready to discover how your digital footprint could be your ticket to better loans and financial opportunities. The credit score dilemma: why traditional methods fall short. Have you ever felt like your credit score doesn't really capture who you are financially? You're not alone. Millions of people feel frustrated when they look at that 3-digit number and think, this doesn't tell my whole story. And you know what? They're right. Let's talk about why traditional credit scoring methods just aren't cutting it anymore. Think about it. We live in a world where you can pay for coffee with your phone and invest in stocks with a few taps on an app. But when it comes to determining your creditworthiness, we're still relying on methods that were developed decades ago. It's like trying to navigate a smart city with a paper map from the 1980s. The FICO score, which has been the go-to measure for lenders since the 1980s, only looks at a narrow slice of your financial life. It's all about your history with credit cards, loans, and mortgages. But what if you're young and haven't had the chance to build up that history yet? Or what if you prefer to use cash or debit cards? Suddenly, you're left out in the cold, labeled as credit invisible. And we're not talking about a small group of people here. According to the Consumer Financial Protection Bureau, about 26 million Americans are credit invisible, meaning they have no credit history with one of the 3 nationwide credit reporting companies. That's a lot of people who might be great with money, but can't prove it in the traditional system. This problem hits millennials and Gen Z especially hard. Think about it. You graduate from college, maybe with some student loans, and you're trying to start your adult life. You need an apartment, but landlords want to check your credit. You're looking for a job, and some employers run credit checks. You want to buy a car, but you need a loan. At every turn, you're facing obstacles because you haven't had the chance to build a credit history yet. But it's not just young people who suffer. Traditional credit scores can penalize you for common life events that don't necessarily reflect bad financial habits. Got laid off and missed a couple of payments? Your score takes a hit. Closed an old credit card account you weren't using anymore? That could lower your score too. Paid off a loan early? Believe it or not, that might not help your score and could even hurt it in some cases. The system seems designed to keep you in a constant state of borrowing, which isn't always the healthiest financial strategy. It's like being told you need to eat junk food to prove you have a healthy diet. Here's the thing. Your financial health is about so much more than whether you pay your credit card bill on time. It's about how you manage your day-to-day expenses, whether you're saving for the future, and how you handle unexpected costs. But traditional credit scoring methods don't capture any of that. And in today's digital world, there's so much more data available that could paint a more accurate picture of your financial responsibility. Your rent payments, your utility bills, even your job performance could all be relevant factors. But the old system just isn't set up to consider these things. The good news is, change is on the horizon. As we look ahead to 2025, we're seeing a revolution in credit scoring, powered by artificial intelligence. These new AI-driven systems are set to transform how lenders evaluate your creditworthiness, taking into account a much wider range of factors to give a more holistic view of your financial health. Imagine a world where your credit score reflects not just your borrowing history, but your overall financial behavior. A world where paying your rent on time every month actually helps your credit, where your steady employment is seen as a positive factor, and where your responsible use of a budgeting app is recognized as a sign of financial savvy. This isn't just a pipe dream. It's already starting to happen, and by 2025, it's likely to be the new normal. These AI-powered systems will be able to analyze vast amounts of data quickly and accurately, creating a more nuanced and fair picture of each individual's creditworthiness. For millions of people who have been left out or unfairly penalized by the traditional system, this could be a game changer. It could mean easier access to loans, better interest rates, and more opportunities to build wealth and financial stability. The rise of alternative data. Your digital footprint matters. Let's talk about something that's going to change the game for your financial future. You know how your credit score has always been based on a pretty narrow set of factors? Well, that's about to change in a big way. We're entering a world where your entire digital footprint could become a valuable asset when it comes to getting loans or credit cards. Think about it. Your online life is a treasure trove of information about who you are and how you handle money. And now, AI is stepping in to make sense of all that data. It's not just about whether you pay your bills on time anymore. It's about the whole picture of your financial behavior. So, what exactly is this alternative data we're talking about? It's basically any information that isn't traditionally used in credit scoring. This could include things like your utility payments, rent history, or even how you manage your checking account. But it goes even further than that. Your social media activity, the apps you use, and your online shopping habits could all potentially play a role in painting a picture of your financial responsibility. Now, you might be thinking, wait a minute, how does my Instagram feed relate to my ability to pay back a loan? Well, here's the thing. AI can spot patterns and connections that humans might miss. For example, if you're always posting about your latest shopping sprees, it might suggest you're a big spender. On the flip side, if you're sharing tips about budgeting or investing, it could indicate that you're financially savvy. But it's not just about what you post online. Alternative data can also include things like how often you pay your cell phone bill on time, or whether you've ever had your electricity cut off. These might seem like small details, but they can actually say a lot about how reliable you are when it comes to managing your money. Here's where it gets really interesting. The Consumer Financial Protection Bureau, CFPB, has been looking into this stuff, and they've found some pretty eye-opening things. They've pointed out that the old way of doing credit scores often misses the mark when it comes to capturing the complexities of how we handle money today. It's like trying to describe a movie by only looking at the poster. You're missing out on a lot of important details. The CFPB has even discovered that some of the things we've always thought were super important for credit scores might not be as big a deal as we thought. For instance, they found that medical debts don't really tell us much about whether someone can pay back other kinds of debts. That's why they're pushing for changes that would take medical debts off credit reports altogether. Now, you might be wondering about privacy. After all, the idea of AI digging through your online life might sound a bit creepy. But here's the thing. There are actually some pretty strict rules in place to protect your data. Companies that use alternative data for credit scoring have to follow regulations about how they collect and use that information. Plus, you usually have to give permission for them to access your data in the first place. Some companies are already jumping on board with this new approach. For example, there are lenders out there who will look at things like your education level or your job history when deciding whether to give you a loan. They're finding that these factors can sometimes be better indicators of whether you'll pay back a loan than just your credit score alone. But here's where it gets really exciting. This alternative data approach could be a game changer for people who've been left out of the traditional credit system. Maybe you're young and haven't had time to build up a credit history yet. Or maybe you're someone who's always paid your rent and utilities on time, but never had a credit card. With alternative data, all of that responsible behavior could finally be recognized and rewarded. AI algorithms, the new credit score calculators. You might think you're pretty good at managing your money, but what if I told you there's a new financial whiz in town? It's not a person, it's an algorithm. And it's about to turn everything you know about credit scores upside down. Let's talk about how AI is becoming the new credit score calculator. Think about all the financial decisions you make every day. From buying your morning coffee to paying your rent, each transaction tells a little story about your money habits. Now, imagine a super smart computer that can read all those stories and understand what they mean for your financial future. That's exactly what AI is doing. These AI algorithms are like financial detectives, sifting through mountains of data to piece together a picture of your credit health. But here's the thing. They're not just looking at whether you pay your credit card bill on time. They're considering so much more. Remember how we talked about alternative data? Well, AI is taking that idea and running with it. AI can spot patterns in your financial behavior that even you might not notice. Maybe you always pay your rent a few days early, or you never overdraw your checking account. These little habits might seem small to you, but to an AI, they're valuable clues about how responsible you are with money. But what makes AI really special is its ability to learn and adapt. Think about how quickly the economy can change. One day everything's fine, and the next there's a global pandemic turning the world upside down. Traditional credit scores can take months or even years to catch up with these big shifts. But AI, it's constantly updating, taking in new information, and adjusting its understanding in real time. This means your credit score could change as quickly as your financial situation does. Lost your job? AI might recognize that you're still managing your money carefully despite the setback. Got a promotion? Your improved financial health could be reflected in your score almost immediately. It's like having a credit score that grows and changes with you, instead of always playing catch-up. AI is also a superhero when it comes to spotting fraud. It can detect unusual patterns in your spending that might indicate someone's stolen your identity, often before you even notice anything's wrong. This doesn't just protect you, it also helps lenders feel more confident about working with you. Now, you might be wondering, can we really trust a computer to make such important decisions about our financial lives? It's a fair question. There have been concerns about AI bias in credit scoring, just like there have been in other areas where AI is used. But here's some good news. There are serious efforts underway to make sure AI credit scoring is fair and transparent. One big push is for something called explainable AI. This means creating AI models that can actually tell you why they made a certain decision. So instead of just getting a mysterious number, you might get a breakdown of exactly what factors influenced your credit score. This kind of transparency is a big deal. It means you'll have a better understanding of your financial health, and you'll know exactly what you need to do to improve your score. Plus, it helps ensure that the AI isn't making decisions based on unfair or discriminatory factors. In fact, there are some pretty important people pushing for this kind of change. The Consumer Financial Protection Bureau Director, Rohit Chopra, has been talking about the need for a new AI-based credit scoring model. He's advocating for transparency and fairness in how AI is used in credit scoring. This is a big deal because it shows that even at the highest levels, there's recognition that our old way of doing things just isn't cutting it anymore. So, what does all this mean for you? Well, it's pretty exciting. AI algorithms are set to replace traditional credit scoring methods, and that could open up a whole new world of financial opportunities. These smart systems can provide a more nuanced, personalized assessment of your creditworthiness. They can see beyond just the numbers to understand the real you, your habits, your challenges, and your potential. Ethical considerations, balancing innovation and fairness. AI promises a fairer credit system, but it's not without its challenges. Think about it. How do we make sure a computer understands the nuances of your financial life without crossing ethical lines? It's time to tackle the tough questions about balancing innovation with fairness in credit scoring. When we talk about AI making decisions about our financial future, it's not just about convenience or efficiency. It's about fairness, transparency, and trust. Imagine a world where an algorithm determines whether you can buy a house, start a business, or even get a job. It's a reality that's quickly approaching, and it's raising some important ethical questions. Let's be real. AI has the potential to make credit scoring fairer for a lot of people. It can look at a wider range of factors and make decisions faster than any human could. But here's the thing. With great power comes great responsibility. We need to make sure these AI systems aren't accidentally creating new forms of discrimination. Think about it this way. If an AI system is trained on historical data that reflects past biases, it might end up perpetuating those same biases in its decisions. For example, if a neighborhood has historically been redlined, an AI might see that as a high-risk area without understanding the complex social and economic factors at play. That's why transparency in AI decision-making is so crucial. But what does transparency really mean when we're talking about complex algorithms? It's not enough for companies to say, "Trust us, our AI is fair." We need to be able to peek under the hood and understand how these decisions are being made. That's where the concept of explainable AI comes in. Explainable AI is all about making sure we can understand and interpret the decisions made by AI systems. It's like having a translator for the computer's thought process. This is especially important when it comes to something as critical as credit scoring. If you're denied a loan, you deserve to know why, and not just get a vague answer from a black box algorithm. Now, you might be thinking, okay, but how do we actually make sure AI is being fair? Well, that's where regulatory efforts come in. The European Union, for example, is taking a big step with its Artificial Intelligence Act. This act classifies AI systems used for credit scoring as high risk. What does that mean for you? It means these systems will have to meet strict requirements for transparency, accuracy, and human oversight. Speaking of human oversight, that's another key piece of the puzzle. While AI can process vast amounts of data and spot patterns we might miss, it still needs human judgment to contextualize that data and address ethical concerns. It's like having a human co-pilot alongside the AI to make sure decisions are fair and make sense in the real world. Let's talk about a real-world example of how regulators are trying to make credit scoring fairer. The Consumer Financial Protection Bureau, CFPB, recently made a rule to remove medical debt from credit reports. Why? Because they found that medical debt doesn't really tell you much about whether someone can pay back other types of debt. Plus, it often unfairly impacts low-income individuals and minorities. This is the kind of nuanced understanding that we need to build into our AI systems. But it's not just about removing unfair factors. It's also about including factors that give a more complete picture of your financial health. Remember how we talked about alternative data earlier? Well, the ethical use of this data is crucial. Things like your rent payment history or how you manage your checking account could help paint a more accurate picture of your financial responsibility. Now, you might be wondering, is all this regulation going to slow down innovation? It's a fair question. But here's the thing. Ethical AI practices aren't just about avoiding problems. They can actually lead to better, fairer credit assessments. When AI systems are transparent, explainable, and overseen by humans, they're more likely real-time credit monitoring, your financial reputation in motion. Remember when we checked our credit scores once a year? Those days are about to become ancient history. Welcome to the world of real-time credit monitoring, where your financial reputation is always in motion. It's like having a financial fitness tracker strapped to your wallet, constantly updating your credit score with every swipe, tap, or click. Let's talk about what this really means for you. Imagine making a big purchase, like a new laptop, and seeing how it affects your credit score almost instantly. No more waiting around for months to see if that splurge hurt your credit. With real-time monitoring, you'll know right away if you need to adjust your spending habits or if you're on the right track. This is a huge leap from the old way of doing things. Remember those quarterly credit reports? They were like looking at a financial snapshot from months ago. But now, with AI crunching the numbers 24/7, your credit score becomes more like a live video feed of your financial health. So how does this work? Well, AI is constantly analyzing your financial behavior. Every time you pay a bill, make a purchase, or even just check your account balance, the AI takes note. It's looking for patterns and trends in your spending and saving habits. And here's the cool part. It's not just about catching the bad stuff. This AI can also spot when you're making smart money moves and reward you for it. Think about it. You decide to set up automatic payments for your bills. In the old system, it might take months for that responsible behavior to show up on your credit report. But with real-time monitoring, you could see a boost in your score almost immediately. It's like getting a gold star for adulting right when you deserve it. Let's talk about some real-life scenarios where this could make a big difference. Say you're planning to apply for a mortgage in a few months. With real-time monitoring, you can see exactly how your financial decisions are affecting your credit score in the lead-up to your application. You might realize that paying off that small credit card balance could give your score the boost it needs to get you a better interest rate. Or imagine you're traveling and your credit card gets hit with some suspicious charges. In the past, you might not have noticed until your next statement. But with real-time monitoring, you and the AI could spot those weird purchases right away. This quick detection could prevent a full-blown identity theft disaster and save your credit score from taking a nosedive. Now, I know what you're thinking. Hold up, this sounds an awful lot like Big Brother watching my every financial move. And you're not wrong to be a little concerned. The idea of constant surveillance of our financial activity can feel pretty uncomfortable. It raises some big questions about privacy and data security. Here's the thing. While real-time monitoring can offer some great benefits, it's important to be aware of the potential downsides. Some consumers might feel uneasy about the level of monitoring involved in these real-time credit assessments. It's a valid concern, and it's something that both financial institutions and regulators are grappling with. But let's look at the flip side. This constant stream of data can actually lead to more accurate credit assessments. Instead of judging you based on a few snapshots of your financial life, lenders can see the whole picture. They can take into account things like consistent on-time payments, responsible use of credit, and even how you bounce back from financial setbacks. This more holistic view of your finances could be a game changer, especially for people who've struggled with traditional credit scoring methods. Maybe you don't have a long credit history, or you've had some bumps in the road. Real-time monitoring gives you the chance to show how you're managing your money right now, not just what happened in the past. And here's where it gets really exciting. Real-time monitoring puts you in the driver's seat of your credit score. You're not just a passive observer anymore. With immediate feedback on your financial decisions, you can actively manage your credit health. It's like having a personal financial coach in your pocket, giving you tips and encouragement to make smart money moves. The power of small choices. How everyday transactions shape your credit. Let's zoom in on the everyday choices that shape your financial future. You might be surprised to learn that your morning coffee run or your weekly grocery haul could be secretly influencing your credit score. With AI keeping tabs on your spending, it's not just the big purchases that count anymore. Think about it. Every time you swipe your card or tap your phone to pay, you're painting a picture of your financial habits. AI algorithms are now analyzing these patterns in real time, giving lenders a much more detailed view of your money management skills. It's like having a financial fitness tracker, but instead of counting steps, it's counting your smart money moves. Remember how traditional credit scoring used to work? It was all about big-ticket items like mortgage payments or credit card bills. But now, AI is looking at the little things too. That $5 latte you buy every morning? It might actually be helping your credit score if it shows you're consistently making small, manageable purchases and paying them off right away. Here's the thing. AI can tell the difference between necessary spending and splurging. It's not just about how much you spend, but how you spend it. For example, if you're regularly buying groceries and paying your utility bills on time, that's a good sign. It shows you're responsible with your everyday expenses. On the flip side, if you're constantly splurging on luxury items or making late-night impulse purchases, AI might flag that as potentially risky behavior. Let's talk about how this could play out in real life. Imagine you're a freelancer with an irregular income. In the old system, you might have struggled to get a good credit score because your income doesn't fit the traditional 9 to 5 mold. But with AI analyzing your transactions, it can see that even though your income is variable, you're consistently paying your bills and managing your money well. That could give you a big boost when it comes time to apply for a loan or rent an apartment. Or think about someone who's just starting out in their career. They might not have a long credit history, but if AI can see that they're responsibly managing their student loan payments, buying groceries regularly, and setting aside money for savings, that paints a picture of financial responsibility that could open doors for them. Now, you might be wondering about privacy. After all, having AI analyze every coffee purchase and grocery run feels a bit like Big Brother is watching your wallet. And you're right to be concerned. In fact, many consumers are worried about how their financial data is being used and whether it's adequately protected. It's a valid concern, and one that regulators and financial institutions are grappling with. But here's the flip side. This level of detail in transaction analysis can actually be a good thing for many people. Think about folks who work in the gig economy, or small business owners, or anyone else with a non-traditional income source. In the past, they might have struggled to prove their creditworthiness. But now, AI can see the full picture of their financial lives, including all those small, consistent payments that add up to responsible money management. So, what does this mean for you? Well, it's all about being mindful of your everyday financial choices. Every purchase, every bill payment, every savings deposit is like a brushstroke on your financial portrait. And with AI watching, you have the power to actively shape that picture. Here are some smart money moves to consider. 1. Set up automatic payments for your regular bills. This shows consistency and reliability. 2. Use your debit or credit card for everyday purchases rather than cash. This creates a trackable record of your spending habits. 3. Try to maintain a steady balance in your checking account. Wild swings up and down might be seen as a red flag. 4. If you have subscriptions or memberships you don't use, cancel them. Regular payments for services you don't use might be seen as poor money management. 5. Consider using a budgeting app that categorizes your spending. This can help you stay on top of your finances and show AI that you're actively managing your money. Remember, it's not about never treating yourself or living like a financial hermit. It's about showing that you understand the value of money and are making thoughtful choices about how you use it. Beyond bank accounts, the new financial data points. Ever wondered if being a responsible Netflix subscriber could boost your chances of getting a mortgage? Well, in 2025, your financial reputation isn't just about what's in your bank account. It's about the hidden clues in your everyday life that speak volumes about your money habits. Let's explore how the little things you do daily are painting a whole new picture of your creditworthiness. Think about it. Your financial story is no longer just about bank statements and credit cards. It's time to look beyond the traditional playbook. AI-powered credit scoring systems are now considering a much wider range of data points to get a fuller picture of your financial health. And guess what? This could be great news for a lot of people who've been left out in the cold by old-school credit scoring methods. Let's talk about rent payments. If you've been diligently paying your rent on time every month, that's a strong sign of financial responsibility. In the past, this kind of consistent behavior wouldn't have made a dent in your credit score. But now it's becoming a valuable piece of the puzzle. Imagine being able to use your history of on-time rent payments to help you qualify for a mortgage. It's not just a dream anymore, it's becoming a reality. Utility payments are another area where your everyday habits can make a difference. Consistently paying your electric, water, and gas bills on time shows that you're on top of your financial game. These regular payments, which used to fly under the credit radar, are now being factored into the equation. It's like getting credit, pun intended, for something you're already doing. Now, let's talk about the gig economy. If you're a freelancer or have a side hustle, you know that your income can be a bit unpredictable. Traditional credit scoring systems often struggle to account for this kind of variable income. But here's the thing. AI-powered systems are getting smarter about recognizing the patterns in gig work and freelance income. They can see the bigger picture of how you manage your money, even when your paycheck isn't the same every 2 weeks. Here's where it gets really interesting. Remember that Netflix subscription we mentioned earlier? Well, it turns out that your streaming habits could actually be a good thing for your credit score. Consistent payments for subscription services can indicate financial stability. It shows that you're able to manage regular financial commitments, even if they're small. It's not just about the amount you're paying, it's about the habit of responsible financial management. Of course, with all these new data points comes some challenges. How do we make sure all this information is verified and standardized? It's a bit like comparing apples and oranges. Each data point is different, and they need to be weighed and measured in a fair way. The financial industry is working on creating systems to handle this diverse data, but it's still a work in progress. One of the most exciting things about this new approach is how it can help people who've been underserved by traditional banking systems. Think about someone who's never had a credit card or a bank loan. In the past, they might have been seen as a credit risk simply because there wasn't enough information about them. But now, their history of paying rent and utilities on time, managing subscription services, and earning through gig work can all contribute to building a positive financial profile. This broader view of financial behavior is leading to fairer credit assessments. It's not just about how much money you have, it's about how you manage what you have. Are you consistent with your payments? Do you live within your means? These are the kinds of questions that AI-powered systems are getting better at answering, and they're doing it by looking at a much wider range of data than ever before. Blockchain and credit, securing your financial identity. Let's talk about something that's changing the game in credit scoring, blockchain technology. You've probably heard of blockchain in relation to cryptocurrencies, but it's so much more than that. In 2025, it's becoming a powerful tool for protecting your financial identity and making credit scores more secure than ever before. Think about it. Your credit score is like your financial report card. It's a big deal, right? But what if someone could tamper with it or steal your identity? That's where blockchain comes in. It's like a digital ledger that can't be altered once information is recorded. Pretty cool, huh? Here's the thing. Traditional credit reporting systems have some weak spots. They're centralized, which means all your data is stored in one place. That makes them vulnerable to hacks and data breaches. We've all heard those scary stories about millions of people's personal information being stolen. It's enough to make anyone nervous about their financial security. But blockchain flips the script on this problem. Instead of having all your data in one place, it spreads it across a network of computers. Each transaction you make gets recorded as a block and added to a chain of other blocks. Once it's there, it can't be changed without everyone on the network knowing about it. It's like having a whole team of watchdogs guarding your financial information. Now, you might be wondering, how does this actually help my credit score? Well, imagine every time you pay a bill, take out a loan, or make a purchase, it gets recorded on this secure blockchain. Lenders and credit scoring agencies can see this information, but they can't mess with it. This means your credit score becomes a true, tamper-proof reflection of your financial behavior. But it gets even better. Blockchain could give you more control over your own financial data. This is what experts call self-sovereign identity. Sounds fancy, but it's actually pretty simple. It means you decide who gets to see your financial information and for what purpose. You're in charge, not some big corporation. Some companies are already experimenting with blockchain-based credit scoring. For example, there's a startup that's using blockchain to create credit scores for people who don't have traditional banking histories. They look at things like cell phone bill payments and other alternative data to build a credit profile. All of this information is securely stored on a blockchain, making it reliable and fraud-resistant. Now, I know what you're thinking. This all sounds great, but what about my privacy? It's a valid concern. After all, we're talking about some pretty sensitive information here. The good news is that blockchain can actually enhance your privacy. With the right setup, you can choose to share only the specific information a lender needs, without revealing your entire financial history. Blockchain could also be a game changer when it comes to disputing errors on your credit report. We all know how frustrating that can be, right? With blockchain, every transaction is recorded in real time and can't be altered. This means it's much easier to prove what really happened if there's ever a disagreement. No more endless phone calls and paperwork to fix a simple mistake. The Consumer Financial Protection Bureau, CFPB, has been paying attention to these developments too. They've recognized that AI and blockchain working together could create a more transparent and fair credit scoring system. It's all about finding innovative solutions to the challenges we face with current credit assessment methods. Here's another cool thing about blockchain and credit scoring. It could make the whole process more inclusive. Remember how we talked about people who are credit invisible? Blockchain could help them build a verifiable financial history without relying on traditional banking systems. This could be a big deal for people in developing countries or those who've been left out of the traditional financial system. Personalized credit profiles. One size no longer fits all. Let's talk about something that's changing the game in credit scoring. Personalized credit profiles. Imagine if your credit score was as unique as your fingerprint. Well, in 2025, that's becoming a reality. We're moving away from the old one-size-fits-all approach to something much more tailored to you and your financial journey. Think about it. We're all different, right? We have different goals, different lifestyles, and different ways of managing our money. So why should we all be judged by the same rigid standards when it comes to credit? That's where AI comes in. It's creating multidimensional credit assessments that look at you as a whole person, not just a set of numbers. Here's the thing. AI can take into account so much more than just whether you paid your credit card bill on time. It can look at your overall financial picture, including your goals. Are you saving up for a house? Planning to start a business? AI can factor these things into your credit profile, giving lenders a more accurate picture of your financial health and potential. But it doesn't stop there. Life happens, right? Maybe you lost your job for a few months, or you had a medical emergency that drained your savings. In the old system, these events could tank your credit score. But with personalized credit profiles, AI can understand context. It can see that you've always been responsible with your money, and that this setback was just a blip on the radar. Now, you might be wondering, is this fair? How can we compare people if everyone has a different scoring system? That's a great question, and it's something that financial experts are working hard to address. The goal isn't to make comparisons impossible, but to make them more meaningful. Instead of comparing apples to oranges, we're comparing your financial behavior to your own potential and goals. Let's break it down with an example. Say you're a freelancer with an irregular income. In the old system, this might have made you look risky to lenders. But a personalized credit profile could recognize that you consistently pay your bills, even if your income fluctuates. It might also see that you're great at managing your money during lean times. This gives lenders a much clearer picture of your financial responsibility. Or think about this. You're young, just starting out, and you don't have much credit history. In the past, this would have made it hard for you to get a loan or a credit card. But with a personalized profile, AI can look at other factors. Maybe you always pay your rent on time, or you're really good at sticking to a budget. These things show that you're financially responsible, even if you don't have a long credit history. Here's another cool thing about personalized credit profiles. They can lead to more tailored financial products. Banks and lenders can use this detailed information to offer you products that really fit your needs and financial situation. No more one-size-fits-all credit cards or loans. Instead, you might get offers that are specifically designed for your financial goals and habits. Now, you might be thinking, this all sounds great, but how does AI keep learning and adapting? Well, that's one of the most exciting parts. According to research, AI-driven credit scoring systems are capable of continuous learning. This means they adapt to new data and changing consumer behaviors over time. So as your financial situation changes, your credit profile can change with
the lender's perspective. Smarter risks, better decisions. Think about it, we've been talking a lot about how AI is changing the game for borrowers, but what about the other side of the equation? Let's flip the script and look at how AI is shaking things up for lenders. You might be surprised to learn that smarter credit scoring could actually lead to more people getting approved for loans. Here's the thing, traditional underwriting processes have always been a bit of a guessing game. Lenders had to rely on a limited set of data points to make decisions about who to lend money to. It's like trying to put together a puzzle with half the pieces missing. But AI is changing all that. With AI-driven credit scoring, lenders can now see the whole picture. They're not just looking at your credit score anymore, they're analyzing a whole range of data points that give them a much clearer idea of your financial health. This means they can make smarter, more accurate decisions about lending. Let's talk about what this means in practice. AI can help lenders identify borrowers who might have been overlooked by traditional scoring methods. Maybe you're someone who doesn't have a long credit history, but you always pay your rent and utilities on time. An AI system can pick up on these positive patterns and flag you as a potentially reliable borrower. This is huge news for people who've been left out of the traditional credit system. The Consumer Financial Protection Bureau, CFPB, has some eye-opening stats on this. They estimate that removing medical debt from credit reports could lead to about 22,000 more affordable mortgages being approved each year. That's 22,000 families who might be able to buy their first home, all thanks to smarter credit scoring. But it's not just about approving more loans, it's about approving the right loans. AI can help lenders assess risk more accurately, which means they can feel more confident about their lending decisions. This could lead to lower interest rates for borrowers who might have been considered higher risk under the old system. Now, you might be thinking, this all sounds great, but how do we know we can trust these AI systems? It's a fair question. There's been a lot of talk about the black box nature of AI decision-making, and it's true that some AI systems can be hard to understand. But here's the good news. The financial industry is working hard to make AI more transparent. They're developing what's called explainable AI systems that can break down their decision-making process in a way that humans can understand. This means lenders can explain to you exactly why you were approved or denied for a loan, which is a big step forward in terms of fairness and transparency. Let's talk about some real-world examples of how this is playing out. Some online lenders are already using AI to offer loans to people who might not qualify under traditional criteria. They're looking at things like your education level, job history, and even your online behavior to get a more complete picture of your financial health. And it's not just about saying yes or no to loans. AI is helping lenders offer more personalized products. Maybe you're someone who's great at saving but has a thin credit file. An AI system might identify you as a good candidate for a secured credit card with a path to upgrade to an unsecured card after a certain period of good behavior. The really exciting part is that this creates a win-win situation for both lenders and borrowers. Lenders can expand their customer base and offer more competitive products, while borrowers get access to more financial opportunities and potentially better terms. Buy now, pay later, the new credit test. Let's talk about a new player in the credit game that's shaking things up in ways you might not expect. You've probably heard of buy now, pay later services, right? These are the handy little options that pop up when you're shopping online, letting you split your purchase into smaller, often interest-free payments. They've become super popular, especially with younger shoppers who might not have traditional credit cards. But here's the thing, these seemingly small, everyday choices about how you pay for your online shopping could have a big impact on your financial future. In 2025, AI-powered credit scoring systems are starting to look at your buy now, pay later habits as a way to understand how you manage your money. Think about it, when you use a buy now, pay later service, you're essentially taking out a mini loan. And just like any other loan, how you handle it says a lot about your financial habits. Are you making those payments on time? Are you using these services responsibly? Or are you overextending yourself? This is where AI comes in. These smart systems can look at your buy now, pay later behavior and pick up on patterns that might not be obvious to the human eye. For example, if you consistently use buy now, pay later for small, manageable purchases and always pay on time, that could be a sign of good financial planning. You're using the service as a tool to manage your cash flow, not as a crutch for overspending. On the flip side, if you're frequently maxing out your buy now, pay later limits or missing payments, that could raise some red flags. It might suggest that you're having trouble managing your short-term finances, which could make lenders nervous about bigger, long-term loans. Now, you might be wondering, how could my choice to split a $100 online purchase into 4 payments possibly affect something as big as a mortgage application? Well, in the world of AI-powered credit scoring, every financial decision counts. These small transactions can build up a detailed picture of your money management skills over time. For instance, let's say you're a freelancer with an irregular income. Traditional credit scoring might struggle to assess your creditworthiness because your income doesn't follow a typical pattern. But if AI can see that you consistently use buy now, pay later services responsibly, making purchases when you know you have money coming in and always paying on time, that could actually work in your favor. It shows you're good at managing your cash flow, even when your income is unpredictable. Or maybe you're just starting out in your career and haven't had the chance to build up a traditional credit history. In the past, this might have made it hard for you to get approved for loans or credit cards. But if you've been using buy now, pay later services responsibly, that could give lenders a window into your financial behavior. It's like a mini credit history showing how you handle small-scale borrowing. Of course, there are some concerns about this new trend. Some financial experts worry that easy access to buy now, pay later services might encourage overspending, especially among younger consumers. It's easy to lose track of how much you've committed to pay when it's spread out over time, and those small payments can add up quickly. But here's where AI could actually help. These smart systems can look at your overall spending patterns, not just individual transactions. They might be able to tell the difference between someone who's using buy now, pay later as a budgeting tool and someone who's using it to live beyond their means. For example, if you're using buy now, pay later for a big purchase like a new laptop for work, and you've planned out how you'll make the payments, that could be seen as responsible financial planning. But if you're constantly using these services for impulse buys or luxury items, that might not look so great. The key is to remember that in 2025, every financial decision you make could be part of your credit story. By now, pay later services aren't just a convenient way to shop. They're becoming a new kind of credit test. How you use them could give lenders valuable insights into your financial habits and help shape your overall credit profile. Medical debt, a thing of the past? Let's talk about a game changer in the credit world that's about to make life a whole lot easier for millions of Americans. Imagine a world where a sudden health crisis doesn't leave a lasting scar on your credit report. Well, in 2025, that's becoming a reality, and it's shaking up the way we think about credit scores. Think about it, 4 years medical debt has been a thorn in the side of countless people. You get sick, you get treatment, and then bam, you're hit with a bill that can take years to pay off. And all that time, your credit score takes a hit, making it harder to get loans, rent apartments, or even land certain jobs. It's been a vicious cycle that's trapped many folks in a financial nightmare. But here's the thing, the Consumer Financial Protection Bureau, CFPB, has decided enough is enough. They've put their foot down and said, no more. Starting in 2025, medical debt is getting the boot from credit reports. It's a huge shift that's going to change the game for millions of people. Now, you might be wondering, why the big change? Well, the CFPB did their homework and found out something pretty interesting. It turns out that medical debt doesn't really tell lenders much about how good you are with money. Think about it, most of us don't choose when we get sick or how much our treatment will cost. It's not like deciding whether to buy those new shoes or save for a rainy day. So what does this mean for you? If you've been stressing about that lingering hospital bill affecting your credit score, you can breathe a little easier. In 2025, that debt won't be hanging over your head when you apply for a loan or a new credit card. It's like getting a fresh start, financially speaking. But it's not just about wiping the slate clean. This change is opening up doors for people who've been shut out of the financial system. Think about a young couple trying to buy their first home. In the past, a medical emergency might have crushed their dreams of homeownership. But with this new policy, they might just get the mortgage they need to start building their life together. Now, you might be thinking, this sounds great, but what's the catch? It's a fair question. Some folks are worried that removing medical debt from credit reports might make it harder for lenders to get a full picture of someone's financial health. But here's where AI comes into play. In 2025, AI-powered credit scoring systems are getting smarter about how they look at debt. They're not just seeing a big number, they're understanding the story behind it. These systems can tell the difference between someone who's struggling with medical bills and someone who's racking up credit card debt on shopping sprees. Let's break it down with an example. Say you've got two people, let's call them Alex and Jordan. Both have $10,000 in debt. In the old system, they might look pretty similar on paper. But the AI can see that Alex's debt is from a surgery they needed, while Jordan's is from overspending on luxury items. The AI understands that Alex's situation doesn't necessarily mean they're bad with money, while Jordan's might raise some red flags. This more nuanced view means that lenders can make fairer decisions. They're not just looking at a single number anymore. They're seeing the whole picture of your financial life. But it's not just about distinguishing between types of debt. AI is also getting better at understanding how people manage their finances overall. It can look at things like how consistently you pay your bills, how you handle your day-to-day expenses, and how you save for the future. All of this paints a much more accurate picture of your financial health than just looking at whether you have medical debt or not. Now, let's talk about what this means for you in practical terms. If you've been putting off medical treatment because you're worried about the impact on your credit score, you can feel more comfortable seeking the care you need. Your health shouldn't have to take a backseat to your financial concerns. And if you're one of the millions of Americans who've been struggling with medical debt, this change could be your ticket to better financial opportunities. Maybe you'll finally be able to qualify for that car loan or get approved for an apartment you've had your eye on. It's about more than just numbers on a credit report. It's about opening up possibilities for a better life. Small business boost, new rules for entrepreneurial credit. Now, let's shift gears from personal credit to the world of small business. Ever wondered if your Instagram shop or weekend dog walking service could actually help you secure funding for a full-fledged business? Well, in 2025, that's becoming a reality, and it's turning traditional business credit on its head. Think about it, in the past, getting a business loan often meant having years of established credit history, solid revenue, and a track record of success. But what about all those side hustlers and budding entrepreneurs who are just getting started? The good news is the credit game is changing to support small businesses in a big way. In 2025, new credit reporting rules are shaking things up for small businesses. Instead of just looking at traditional metrics like your business credit score or years in operation, lenders are starting to consider a whole range of factors that paint a more complete picture of your entrepreneurial potential. Let's say you've been running a successful Etsy shop on the weekends while working your day job. In the past, that might not have counted for much when applying for a business loan. But now, AI-powered credit systems can analyze your Etsy sales data, customer reviews, and even your social media engagement to get a sense of your business acumen and potential for growth. Or maybe you're a freelance graphic designer who's been piecing together income from various gig economy platforms. The new credit rules recognize that irregular income doesn't necessarily mean financial instability. AI can look at your overall income trends, client retention rates, and even the diversity of your skill set to assess your creditworthiness. This shift is all about recognizing the changing nature of work and entrepreneurship. The gig economy, side hustles, and online businesses are becoming more and more common, and the credit system is finally catching up. But it's not just about online businesses. Let's say you run a local food truck. The new credit rules might take into account things like your daily sales data, customer ratings, and even your ability to adapt to seasonal changes in demand. All of these factors can give lenders a more nuanced understanding of your business's health and potential. One of the most exciting aspects of these changes is how they can level the playing field for small businesses. In the past, it was often the case that the biggest companies with the most established credit histories had the easiest time securing loans. But now, a small startup with an innovative business model and a growing customer base might have just as good a chance at securing funding. This could be a game changer for minority-owned businesses and businesses in underserved communities. By looking at a wider range of factors, the new credit rules can help overcome some of the systemic barriers that have historically made it harder for these businesses to access capital. Of course, with all these changes come some concerns. Privacy and data security are big issues when it comes to small business credit. After all, you're sharing a lot of sensitive information about your business operations. It's important to understand what data is being collected and how it's being used. The good news is that many of the same blockchain technologies being used to secure personal credit data are also being applied to business credit. This means your business data can be securely stored and shared only with the parties that need to see it. Another concern is the potential for bias in AI-driven credit decisions. Just like with personal credit, it's crucial that these systems are regularly audited and updated to ensure they're not perpetuating unfair practices. But overall, these changes represent a huge opportunity for small businesses and entrepreneurs. By recognizing the diverse ways that modern businesses operate and succeed, the new credit rules can help fuel innovation and economic growth. Imagine a world where your passion project could become a full-time business, backed by the funding you need to grow, or where your innovative startup idea could compete on a level playing field with established companies when it comes to securing loans. Preparing for 2025. Building your digital credit profile. Let's talk about preparing for the credit revolution of 2025. You might be wondering, how can I start boosting my AI credit score today? Well, the good news is that you don't have to wait until 2025 to get ahead of the game. There are steps you can take right now to build a strong digital credit profile. Think about it, the way we build credit is changing. Gone are the days when simply paying your credit card bill on time was enough. In this new world of AI-powered credit scoring, every aspect of your financial life matters. From your social media presence to your online shopping habits, it's all part of the picture. Here's the thing. Maintaining a positive online presence is becoming just as important as maintaining a good credit score. AI systems are looking at your digital footprint to get a sense of who you are and how you handle your finances. So, how you present yourself online could impact your creditworthiness. But don't worry. This doesn't mean you need to become an influencer or share every detail of your life online. It's more about being mindful of what you do share. For example, if you're a freelancer, sharing updates about your work or professional achievements could signal financial stability to AI systems. Now, let's talk about leveraging alternative data sources to your advantage. Remember, AI is looking at more than just your bank statements. It's considering things like your utility payments, rent history, and even your subscription services. So, setting up automatic payments for your bills isn't just convenient. It's a smart money move that could boost your AI credit score. Here are some small actions that can have a big impact on AI credit assessments. 1. Use a budgeting app to track your spending. This shows you're actively managing your finances. 2. If you're a gig worker or freelancer, keep detailed records of your income and expenses. AI systems are getting better at recognizing these non-traditional income patterns. 3. Consider using buy now, pay later services responsibly for planned purchases. This can demonstrate good financial planning. 4. Maintain a steady balance in your checking account. Wild fluctuations might raise red flags in AI assessments. Now, I know what you're thinking. What about my privacy? Do I really want all this information out there? It's a valid concern, and it's all about finding the right balance. You don't have to share everything, but being strategic about what you do share can work in your favor. For example, you might choose to allow your rent payments to be reported to credit bureaus. Or you could opt into programs that consider your utility payment history when assessing your creditworthiness. These are ways to build your digital credit profile without oversharing. Speaking of rights, it's crucial to understand yours in this new credit landscape. As AI takes on a bigger role in credit scoring, there's a push for more transparency. You have the right to know what factors are influencing your credit score and to dispute any inaccuracies. Stay informed about changes in credit reporting rules and don't be afraid to ask questions if something doesn't seem right. Here's the exciting part. By proactively managing your digital footprint, you can actually boost your creditworthiness. It's not just about avoiding negative marks anymore. It's about actively creating a positive financial image. Every time you pay a bill on time, make a responsible purchase, or demonstrate good money management, you're adding to your digital credit profile. Think of it like tending a garden. Each positive financial action is like planting a seed. Over time, these seeds grow into a lush, healthy financial profile that AI systems will recognize and reward. And the best part? You don't have to wait years to see the results. With real-time credit monitoring,
Opting out,
you can see the
navigating
impact
traditional
of your
paths in a
actions much
digital
more
world.
quickly.
Let's talk about a growing concern in our increasingly digital world. Maintaining good credit without sharing your entire life with AI systems. It's a valid worry, and you're not alone if you're feeling uneasy about the idea of algorithms analyzing your every move. The truth is, while AI-driven credit scoring offers some exciting possibilities, it's not for everyone. Some folks are rightfully concerned about privacy and the potential for bias in these systems. So what if you want to opt out? Is it even possible to keep a good credit score while keeping your data to yourself? The good news is that in 2025, you'll still have options. Some lenders are expected to continue offering traditional credit assessment methods alongside the new AI-powered systems. This means you might be able to apply for loans or credit cards based on your FICO score and standard credit report, just like in the old days. But here's the thing, choosing the traditional path might come with some drawbacks. As more lenders adopt AI scoring, those who stick to old-school methods might find themselves with fewer options. You could miss out on some of the benefits that come with AI scoring, like faster approval times or more personalized interest rates. So how can you build and maintain good credit in 2025 without letting AI peek into every corner of your life? Well, many of the tried-and-true methods will still work. Paying your bills on time, keeping your credit utilization low, and maintaining a mix of credit types will continue to be solid strategies. For example, you might focus on building a strong relationship with a local credit union or community bank. These institutions often take a more personal approach to lending, considering factors beyond just your credit score. They might look at your employment history, your savings habits, or even get to know you as an individual. Another option could be to use secured credit cards or become an authorized user on someone else's credit card. These methods can help you build credit without necessarily exposing all your data to AI systems. But let's be real, opting out of AI-driven credit scoring in 2025 might mean you'll have to work a bit harder to prove your creditworthiness. You might need to provide more documentation when applying for loans or credit cards. And you could miss out on some of the conveniences that come with AI scoring, like real-time updates to your credit profile. It's also worth considering that while you might be able to avoid sharing your social media data or online shopping habits, some level of digital footprint is probably unavoidable in 2025. Even traditional credit scoring methods will likely incorporate more digital elements than they do today. The key is to understand the trade-offs. By opting out of AI scoring, you're prioritizing privacy and control over your data. But you might be sacrificing some convenience and potentially limiting your options. It's all about figuring out what matters most to you. If you do decide to go the traditional route, there are ways to minimize your digital exposure while still maintaining good credit. You might choose to use cash or prepaid cards for most of your daily spending, reserving credit cards for specific credit-building purposes. You could also be selective about which online services you use, opting for privacy-focused alternatives when possible. Remember, though, that even if you're not sharing your entire digital life, consistency is still key. Regular, on-time payments and responsible credit use will continue to be the foundation of a good credit score, regardless of how it's calculated. Financial Literacy 2.0, understanding your AI credit score. Imagine a world where your credit score changes in real time, based on factors you might not even be aware of. Sounds like science fiction, right? Well, welcome to the reality of AI-driven credit scoring in 2025. It's a whole new ballgame, and we're about to learn the rules. Let's talk about financial literacy 2.0. It's not just about knowing how to balance a checkbook anymore. In this new world, understanding your AI credit score is like having a superpower. It's the key to unlocking financial opportunities you never knew existed. Think about it. Traditional credit scores were pretty straightforward. Pay your bills on time, don't max out your credit cards, and you're golden. But AI credit scoring? It's like trying to solve a puzzle where the pieces keep changing shape. The algorithm is constantly learning and adapting, considering factors that might surprise you. So, how do we crack this code? First, we need to understand that AI doesn't just look at your payment history. It's analyzing your entire financial behavior. That morning coffee you buy every day. The algorithm might see that as a sign of consistent spending habits. The way you manage your streaming subscriptions? That could show how well you budget. For recurring expenses. Here's the thing. You don't need to be a tech genius to understand AI credit scoring, but you do need to stay informed. Financial education is more important than ever. Look for resources that explain AI in simple terms. Many banks and credit unions are offering workshops on this topic. Online courses and podcasts can be great tools too. The key is to find information that's clear, up-to-date, and relevant to your situation. Let me give you an example of how this knowledge can make a difference. Sarah, a freelance graphic designer, learned about AI credit scoring and realized her irregular income might be seen as a risk. So, she started using a budgeting app to track her expenses and set aside money for taxes. She also made sure to pay her rent and utilities on time, even during slow months. When she applied for a car loan, the AI system recognized her responsible financial behavior, despite her fluctuating income. She got approved for a better rate than she expected. Now, I know what you're thinking. How can we keep up with all these changes? It feels like financial technology is moving at warp speed. But here's the good news. You don't have to know everything. Focus on the basics. Understanding your spending patterns, managing your debts, and saving for the future. These fundamentals will always be important, no matter how advanced the AI becomes. Let's talk about why this matters beyond just getting good loan terms. Financial literacy in the AI age is about empowerment. When you understand how these systems work, you can advocate for yourself. You can question decisions that don't seem fair. You can make sure your financial story is being told accurately. Think about it this way. AI credit scoring has the potential to open doors for people who were left out of the traditional system. But that only works if the AI is fair and ethical. And guess what? Your financial literacy plays a role in that. The more informed consumers are, the more pressure there is on companies to create transparent, unbiased systems. So, what can you do to boost your financial literacy 2.0? Start by taking a close look at your digital footprint. How do you manage your online accounts? Are you consistent with your payments across different platforms? These are the kinds of things AI might be looking at. Next, get comfortable with data. Learn how to read your own financial reports. Understand what information is being collected about you and how it might be used. This knowledge is power in the AI age. Finally, don't be afraid to ask questions. If you're applying for a loan and the decision is based on AI scoring, ask for an explanation. Many companies are working on making their AI systems more transparent. Take advantage of that. The future of credit, beyond 2025. While we've explored the exciting changes coming to credit scoring in 2025, let's take a moment to look even further into the future. What if your credit score could do more than just approve loans? What if it could predict your financial future? As we move beyond 2025, the world of credit scoring is set to undergo even more dramatic transformations. Imagine a system that doesn't just look at your past financial behavior, but uses advanced AI to forecast your future financial health. This isn't science fiction. It's a very real possibility that's already in development. One of the most intriguing concepts on the horizon is the idea of predictive credit scoring. Instead of just telling lenders whether you're likely to repay a loan, these advanced systems could provide insights into your long-term financial trajectory. They might analyze factors like your career path, education, and even your social connections to estimate your future earning potential and financial stability. Think about how this could change the game. A recent graduate with a modest income but a degree in a high-growth field might receive a more favorable credit assessment based on their projected career trajectory. Or a small business owner showing strong growth potential could access better financing options, even if their current revenue is still modest. But it's not just about lending decisions. As credit scoring systems become more sophisticated, they could be used in all sorts of ways we haven't even thought of yet. For example, what if your credit score could help you find the perfect job? Employers might use these advanced assessments to identify candidates who are not just qualified, but also financially responsible and stable. Or consider how this could impact healthcare. Advanced credit scoring systems might be able to predict your likelihood of developing certain health conditions based on your financial behavior. This could lead to personalized health insurance plans or early interventions to prevent costly medical issues down the line. Of course, with great power comes great responsibility. As credit scoring systems become more predictive and all-encompassing, we'll need to have serious conversations about privacy, data security, and fairness. How much of our personal information are we willing to share in exchange for better financial opportunities? And how can we ensure that these systems don't perpetuate or exacerbate existing inequalities? Another exciting possibility is the development of global, standardized credit systems. As our world becomes increasingly interconnected, there's a growing need for credit scores that can travel with you across borders. Imagine being able to move to a new country and immediately access financial services based on your existing credit history. This could be a game changer for international students, expats, and global businesses. But creating such a system would be no small feat. It would require unprecedented cooperation between governments, financial institutions, and tech companies. And it would need to navigate a complex web of different legal systems, cultural norms, and economic conditions. As we look to the future, it's clear that the relationship between consumers and their credit scores is going to become much more dynamic and interactive. You might receive real-time updates and personalized advice on how to improve your financial health. Imagine an AI assistant that could warn you when you're about to make a purchase that could negatively impact your credit score, or suggest smart money moves based on your unique financial situation. This level of engagement could transform how we think about financial education. Instead of learning about credit in abstract terms, you'd be getting constant, practical feedback on your financial decisions. This could lead to a more financially savvy population, better equipped to navigate the complexities of the modern economy. But let's not get ahead of ourselves. While these future possibilities are exciting, they also come with risks and challenges. As credit scoring systems become more complex and influential, there's a danger of creating a black box that's difficult for consumers to understand or challenge. We'll need to strike a careful balance between innovation and transparency. There's also the question of how these advanced systems might impact financial inequality. On one hand, they could provide opportunities to people who are currently excluded from the traditional financial system. On the other hand, if not properly designed and regulated, they could exacerbate existing disparities or create new forms of discrimination. That's why it's crucial that we maintain an ongoing dialogue between consumers, lenders, regulators, and technology developers. We need to ensure that as credit scoring evolves, it does so in a way that's fair, transparent, and beneficial to society as a whole. Let's talk about the future of credit scoring. In 2025, your digital footprint is becoming your financial fingerprint. Every online purchase, social media post, and digital interaction could shape your creditworthiness. But here's the thing, this isn't something to fear. It's an opportunity to take control of your financial story. Think about it. These new credit scoring methods are opening doors that were once closed. They're looking beyond just your bank balance, considering your whole financial picture. This means freelancers, gig workers, and young adults have a better shot at loans and financial products that fit their unique situations. So, what's the smart money move here? Stay informed about how AI is changing credit scoring. Manage your digital presence wisely. It's not just about privacy, it's about showcasing your financial responsibility. And remember, you're in charge of your financial future. By understanding and embracing these changes, you're setting yourself up for better opportunities and a stronger financial